Something extraordinary is unfolding in the global economy, yet most people barely notice it. There is no official announcement, no dramatic headline declaring the beginning, no bell ringing on a trading floor. And still, trillions of dollars are quietly changing direction. Capital is migrating across sectors, across countries, across technologies. Old advantages are weakening. New centers of power are forming. Fortunes that took generations to build may erode, while entirely new ones are being created at a speed that feels almost unnatural. This is how the largest wealth transfers in history usually begin. Invisibly. By the time the majority recognizes what happened, the repricing is already far advanced. We tend to imagine wealth transfer as a single explosive event, like a market crash or a currency collapse. But more often, it is a process, slow at first, then sudden, subtle in mechanics, but enormous in outcome. Factories once replaced farms. Oil replaced coal. Digital platforms replaced physical distribution. Each time, capital did not disappear. It moved. And those positioned on the receiving side experienced growth that later generations describe as obvious, inevitable, even easy. But it never felt easy in real time. Today, we may be standing at a similar threshold. Technological acceleration, demographic shifts, energy transitions, and geopolitical realignments are interacting simultaneously. Productivity is being reorganized, supply chains are being rewritten, intelligence is being automated. Labor markets are adapting under pressure. Money follows productivity. Always. If output can be generated faster, cheaper, or with greater precision somewhere else, capital will eventually relocate there. Not because of ideology, but because competitive systems reward efficiency. This creates discomfort. Regions that benefited from older models experience stagnation. Skills that once guaranteed stability become less valuable. Companies built for previous conditions struggle to maintain margins. Meanwhile, emerging players attract funding, talent, and political attention. From the outside, it may appear chaotic. From the perspective of long-term economic evolution, it is consistent. Consider what happens when new infrastructure emerges. Railroads reorganized trade geography. Electricity enabled entirely new industries. The internet dissolved barriers of distance. Artificial intelligence is now reorganizing decision-making itself. The implications are profound. When intelligence scales, small advantages compound rapidly. Firms that deploy automation effectively can iterate faster, lower costs, and capture market share before competitors understand what changed. Investors observing these dynamics begin reallocating resources toward anticipated winners. This reallocation becomes self-reinforcing. Higher valuations make it easier to raise capital. Greater capital accelerates innovation. Faster innovation strengthens dominance. Over time, leadership concentrates. The wealth transfer deepens. Yet, while new fortunes expand, old structures rarely surrender gracefully. Incumbents lobby for protection. Regulators debate fairness. Narratives of disruption generate fear. Markets fluctuate as expectations collide with uncertainty. Volatility is not a side effect of transformation. It is part of the mechanism. Prices swing because participants disagree about the future. Some see temporary excitement, others see permanent change. The tension between those interpretations produces opportunity for disciplined observers. But discipline requires perspective. If we examine previous transitions, we find that early phases were filled with bankruptcies, failed experiments, and painful corrections. Nevertheless, the overall trajectory of productivity continued upward. Over time, the cumulative benefits outweighed the interim damage. Wealth was not destroyed. It was redistributed toward adaptability. This is an uncomfortable conclusion because adaptability is unevenly distributed. It depends on education, access to capital, institutional stability, and cultural willingness to evolve. Some communities move quickly. Others resist. Markets tend to reward speed. For retail investors, the challenge is identifying where durable momentum is forming without surrendering to speculative excess. Headlines amplify extremes. Social platforms reward certainty. But sustainable strategy often lives in nuance. The future can be transformative without being linear. Periods of enthusiasm may inflate valuations beyond reasonable assumptions. Corrections may follow, yet the underlying direction of technological integration can remain intact. Distinguishing between narrative fluctuation and structural progress is one of the most valuable skills an investor can cultivate. It requires patience. It requires humility. And it requires acceptance that participation rarely feels comfortable. Another aspect of wealth transfer involves generational behavior. Younger cohorts often adopt new systems faster. They build businesses natively within emerging frameworks. Older institutions may adapt, but frequently with delay. Capital gradually shifts toward those who understand the language of the future. Talent migration accelerates financial migration. Universities expand technical programs. Corporations compete for specialized expertise. Governments design incentives to attract innovation hubs. Infrastructure grows around these concentrations, reinforcing their advantage. Network effects develop. At some point, the question changes from will this matter to how did anyone doubt it? But we are not there yet. We are in the messy middle, where signals are mixed and conviction is fragile. This is precisely the environment in which large reallocations begin. Early enough to be doubted, late enough to be meaningful. For individuals, the temptation is to wait for clarity. Unfortunately, clarity often arrives after the most asymmetric returns. History shows that transformative gains typically reward those who tolerated ambiguity while remaining diversified enough to survive mistakes. Perfection was not required. Participation was. This is why risk management remains central even during periods of extraordinary promise. Concentration can magnify success, but it can also eliminate resilience. Broader exposure across enabling technologies, infrastructure providers, and complementary industries may appear less exciting, yet it can create durability. Durability allows compounding, and compounding over time performs miracles that short-term excitement rarely sustains. We should also recognize that wealth transfer is not purely financial. Social influence, political leverage, and cultural narratives evolve alongside capital. Companies that define platforms often shape communication. Those that control data influence research. Economic leadership translates into broader authority. Understanding this helps explain why competition for technological advantage has intensified globally. Nations are not merely investing for profit. They are investing for position. Where this ultimately leads remains uncertain, but the magnitude of commitment suggests that reversal is unlikely. Once vast resources are mobilized, momentum becomes difficult to interrupt. For investors, momentum at that scale matters. It suggests that even if cycles of optimism and pessimism alternate, the long arc may continue bending toward deeper integration of advanced systems into everyday life. Businesses, consumers, and governments adapt step by step, embedding change until it feels normal. Normalization is powerful. What once seemed revolutionary becomes infrastructure. Expectations adjust upward. New opportunities emerge on top of old innovations. Layers accumulate. Value creation compounds. Looking back, the beginnings appear obvious. Living through them, they feel confusing. That is where we stand today. The biggest wealth transfer in history may already be underway, not as a single dramatic explosion, but as a continuous migration toward productivity, scalability, and intelligence. Some will underestimate it, some will chase it recklessly, and some will approach it with measured curiosity and disciplined exposure. Outcomes will likely reflect those attitudes. Because while no one can predict every twist of markets, history consistently favors those who align themselves with expanding capability while protecting their ability to remain in the game. The objective is not to foresee every winner. It is to avoid being absent from the transformation. In periods like this, rational positioning, emotional control, and long-term commitment may prove more valuable than brilliance. The investors who thrive are often those who keep learning, keep adjusting, and resist the urge to declare final answers too early. Wealth moves gradually, then suddenly. And by the time the movement is universally accepted, the transfer is usually far advanced.